All right, picture this. It's 2026. The air is thick with the smell of burning GPUs and the sound of literally everyone, and I mean everyone, sprinting toward the AI goldmine. The hype is everywhere. The FOMO feels like a physical weight on your chest, and if you haven't bought an AI tech stock yet, well, your neighbor is looking at you like you're still rocking a pager. But here's the problem that nobody in the crowd wants to talk about. If every single person is already at the mine with their shovels out, who is actually left to buy your gold once you dig it up?
Look, we all know the AI cycle is in full-blown boom mode right now. It feels like a rising tide that's never gonna stop. But as the legend Howard Marks reminds us in his masterpiece, The Most Important Thing, just riding the tide doesn't stop you from getting swept out to sea when that tide eventually turns. If you want to win in this 2026 market, or honestly just survive it, we've got to stop being sprinters and start being detectives. We need to process the mindset, the psyche, and that defensive armor that Marks laid out for us. Today, we're upgrading your investor brain with the four most powerful tools in our blueprint: EMH, second-level thinking, contrarianism, and intellectual humility. Put on your detective hat, we've got some glitches to find.
Think of investing like a championship boxing match. Before you even step into the ring, you have to know your opponent, their reach, their strength, and their favorite dirty tricks. To beat the market, you first have to understand exactly how the heck it works. Enter the backbone of the modern financial world, the efficient market hypothesis, or EMH. This theory says that because there are millions of smart people and even smarter AI bots working 24/7 to digest every single scrap of info, assets are basically always priced fairly. If a company is worth more, someone would have bought it already. If it's worth less, someone would have sold it. Therefore, the price you see reflects everything that can possibly be known. The conclusion? No one can consistently beat the market because you can't outpredict a machine that sees everything at once.
It's like a super fast processor. It takes all the ingredients, the earnings news, interest rates, and geopolitics, and calculates a fair price instantly. You just can't beat a robot that reads 10,000 pages per second. This is why those simple first-level observations like, hey, AI is good, are already baked into the price tag long before you even open your brokerage app. By the time you think of it, the machine has already chewed it up and spat out a price. So, is the EMH right? Is the market always efficient? Well, if it were 100% right, then why do guys like Warren Buffett and Howard Marks consistently crush the market for decades? If the machine is perfect, why do we see occasions where assets are obviously wildly overpriced or tragically undervalued?
Think of the EMH as a state-of-the-art GPS. Most of the time, it's incredibly accurate. When everyone is driving rationally, it takes in traffic data and speed limits and gives you a flawless arrival time. It does know what the facts mean for the long haul, and the price reflects the crowd's logical expectations. But this GPS has two major blind spots. First, it doesn't account for the human element, like when every driver on the road suddenly has a collective panic attack or decides to throw a massive rowdy parade right in the middle of the highway. Second, it hasn't mapped the small, dusty backroads that nobody else is looking at, those overlooked asset classes that the big institutional players just ignore. This brings us to the secret Howard Marks wants us to understand. The machine has a glitch. It is amazing at processing data, but it is absolutely spectacularly terrible at processing human emotion. When the crowd gets greedy, the machine catches a fever. It starts overpricing everything because it mistakes enthusiasm for value. When the crowd panics, the machine starts selling gold for the price of dirt because it mistakes fear for worthless info. This means that while the price reflects the consensus view, that view is only really correct when people are being rational. But occasionally, especially at market extremes, it's just a bunch of people celebrating or panicking in a room. Look at history. In January 2000, Yahoo was selling for $237. The consensus said it was the king of the internet, and its price reflected total world domination. Fast forward just 1 year to April 2001, that consensus flipped and the price cratered to just $11. Was the market efficient at both of those prices? Heck no. It was just reacting to a massive psychological mood swing. That glitch, that emotional breakdown, that's where the money is made. That's our entry point. To spot that glitch, you need a different gear in your head: second-level thinking. First-level thinking is easy and superficial. It says AI is the future, so I should buy the stock. Everyone does that. But the detective asks, wait a second, everyone thinks AI is the future, so the stock is already priced for a literal miracle. What happens if the miracle is just a regular success?
On the flip side, look at a panic bear market. First-level thinker, sell everything before it goes to zero. The detective, hold on. everyone is terrified. This means the stock price is assuming the absolute worst-case scenario where the entire world ends. But even in the Great Depression, people still needed to eat. If the world doesn't end, these stocks are a once-in-a-century bargain. And then what? Eventually, things will stabilize and I'll be holding assets bought at a 90% discount.
Second-level thinking is deep, complex, and let's be honest, a bit cynical. It's about looking past the obvious and digging into the variables that actually move the needle. It starts by looking at the full range of outcomes, not just what you hope will happen, but everything that could happen. Then you have to play the odds. What's the actual probability of each of those scenarios?
Next, the detective looks at the price tag. Is the market currently paying for a miracle, or is it bracing for a disaster? And finally, and this is the big one, you have to spot the herd's blind spot. What is it that everyone else is so busy sprinting past that they've completely missed? Being a detective means asking the questions the crowd is too busy sprinting to answer. It's about realizing that a great company can be a terrible investment if you pay way too much for it. You have to outthink the consensus and do the hard work to find what the herd missed.
This leads us to the most difficult, loneliest, but most rewarding part of the blueprint, contrarianism. History tells us that most investors are wrong at market extremes. They buy high because they feel safe in the crowd, and they sell low because they're scared. Why? Because the herd doesn't follow logic, it follows that crowd influence cocktail Howard Marks warns about. First, there's the tendency to conform. It's that human herd instinct. In a bull market extreme, when everyone thinks trees grow to the sky and everyone is making money in AI, the pressure to join in is immense, so they just ignore the logic.
Then comes envy. You see your neighbor buy a Tesla with his woof AI gains, and suddenly your sensible strategy feels, well, stupid. Finally, there's capitulation. This is when you finally give in and buy at the very top because the pain of missing out is worse than the fear of losing money. This happens in reverse during a panic bear market. The crowd sees red charts and scary headlines and conforms to the end of the world view. They capitulate and sell everything at the bottom just to make the pain stop. Everyone is sitting in a dark room convinced the sun is never going to rise again. In both cases, the crowd is wrong. Therefore, the key to success is doing the opposite, diverge from the crowd.
But being a contrarian isn't just about being a rebel for the sake of fashion. Marx is crystal clear. You don't do things just because they're the opposite of the crowd. You do them because your reason and analysis tell you the crowd is wrong. To pull this off, you need two essential tools in your kit. First, there's deep homework. Think of this as your reason filter. You've got to put in the hard work to figure out what an asset is actually worth. You aren't just taking a wild guess here, you're analyzing. You need to pinpoint exactly why the crowd's optimism is way overblown or why their panic is totally irrational. Because let's be real, without a rock-solid reason based on facts, you aren't a contrarian, you're just a gambler with a different label. The second tool is standing alone, or what I like to call true independence. You have to be 100% okay with being the only person at the party who isn't drinking the Kool-Aid. This is the superpower of being able to look like an absolute idiot for a while.
It can be incredibly painful when the trend is going against you, especially since markets can stay mispriced for years. You might buy while a stock is falling, and for months, even years, your friends might laugh at you. You have to be okay with being wrong for a bit to be right in the end. You have to tie yourself to the mast of your logic so the sirens of FOMO don't lure you onto the rocks. Success, as usual, comes down to being skeptical of what everyone was saying and doing. As Warren Buffett famously put it, be fearful when others are greedy and be greedy when others are fearful. The key isn't to be a contrarian all the time. It's to ignore the noise and focus on the data the machine is ignoring exactly when the crowd is at its most emotional. The final piece of the detective's brain, knowing what you don't know. In a tech boom like 2026, the most dangerous words are, "I know exactly what's going to happen." The detective knows better. He knows that he doesn't know exactly what's next. Marx teaches us that we don't predict the future, we prepare for a distribution of outcomes. Imagine you're driving in thick fog. You don't know if there's a deer in the road or a bridge out. Knowing what you don't know is like driving slowly and keeping your eyes peeled. If you speed through that fog saying, "I know there's nothing there," you're going to crash. Look, knowing what you don't know really just comes down to admitting the future is a fog. You simply can't see through it. It's about understanding that just because an outcome is likely, that doesn't mean it's certain. Instead of trying to hit the jackpot, you've got to focus on risk management, basically making sure you don't lose your shirt while everyone else is trying to hit the moon. Because in this game, the only way to win in the long run is to keep enough chips on the table so you can actually stay in the game. We don't try to predict the AI revolution, we prepare for the probabilities. The second you bet everything on one single outcome, you aren't an investor anymore, you're just a gambler who forgot to check the odds. In a bear market, staying humble means admitting you have no clue where the bottom is, so you buy in stages instead of going all in at once. And in a bull market, it's admitting you don't know exactly when the bubble is going to pop, so you take some profits along the way while the sun is still shining. Recapping, you've got the brain, you've spotted the glitches, you've learned to outthink the first-level crowd and keep your skin thick when everyone else is panicking. But now you're standing in the middle of a massive swinging mood swing. In the next video, we're going to look at the market clock to see if we're at high noon or 5 minutes to midnight. We're going to talk about the pendulum of investor attitudes and how to make sure it doesn't hit you on the way out. Remember, in the short run, the stock market is a voting machine, but in the long run, it's a weighting machine. Let's make sure we're carrying the right weight. By the way, recently there are widespread worries about the overinvestment of CapEx and AI infrastructure and elevated debts to finance these investments. What's your second-level thinking telling you on this matter? Let me know in the comments below. Subscribe to join the Market Thinker Squad. Thanks for watching.